Hi, my name is Stuart Weems and welcome to the Investopoly podcast. My goal is to share easy to understand evidence-based holistic insights to help you master the game of building wealth. Normally in these Tuesday episodes, I share some case studies with you, profile some of my clients to let you know sort of how the approach that I tend to employ works out in real life. Today, I'm going to change my tact a little bit and answer some listener questions. A couple of weeks ago, I started inviting listeners to send in questions, not necessarily really specific about their circumstances, but, the best questions that are relatively general in nature about some of the things I've been talking about or, some of the things that you've been pondering. And I've really received a heap of these questions, and they're fantastic questions and give rise to topics that I can talk about that might not be a big enough topic to be an episode in of itself, but certainly still important matters to talk about. So I guess a reminder, firstly, if you do have any questions like that, you can email them to questions@investopoly.com.au. It'd be great to receive more. My aim is to answer hopefully all of them. And what I thought I would do is sort of mix up the case study episodes. Maybe I'll do a Q&A episode once a month or perhaps even more often than that. Let's see how it goes. And if you're enjoying these Q&A episodes, let me know because I'll do more of them, of course. The other thing I'm going to do is not cherry pick the questions. I want to make sure that if you have a question that needs to test me on something in particular, like if you disagree with what I've said, let's include it and I'll always respond to it. I'm not going to just cherry pick the good ones, if you like. And as I said, I'll try and get through as many as possible. Anyway, I've got 4 questions to answer today, so let's jump into it. So the first one is from Kyle, and Kyle writes, a lot of your content is centered around building wealth for financial independence at retirement age, which might be 60, 65, with a strong focus on super. My question is regarding investing with the goal of early retirement, 40s if possible, without necessarily using super. For context, I'm 26 years old, sole trader that invests in property and shares with virtually nothing in my super fund. What would you be looking for from a portfolio perspective for early retirement, or what kind of strategies would you consider without using super? And at what point would you start considering or shifting towards super? Excellent question, Kyle. I reckon more and more people are really thinking about, more balance in life, not necessarily working until, you get to a certain age, and hopefully using education because there's a whole lot of, access to better education today in terms of financial education to empower themselves to potentially retire a lot earlier as well. Of course, the strategy or a strategy for someone in particular to fund retirement, beginning sometime in their 40s is going to depend on many different factors, including income. Income's going to be a considerable one. So obviously I don't have that information, and this is not necessarily a forum for me to develop a financial strategy for you in this podcast. But I can talk about some of the things that I'd be thinking about if I was to go and develop a strategy. The first thing is really around gearing. And remember, I recorded a podcast episode where I put forth the idea that it's not really property versus shares. It's really a gearing versus no gearing consideration or question. That is, if you're going to borrow to invest, property is probably the best asset class to use in order to do that. If you're not borrowing to invest, then shares are probably the best asset class. So it's really a borrowing versus not borrowing consideration. So let's talk about gearing, so borrowing to invest, which obviously more relates to property. And there's 2 comments I have. The first one is you've got to be careful with the amount of gearing that you employ in a strategy where you want to have early retirement, because obviously borrowing more destroys cash flow because obviously you're paying more in interest costs and gives you a much higher sensitivity to interest rates. And when you're retired, you don't really want to have huge sensitivity to interest rates because your investment income's not necessarily going to move in line with interest rates unless you're all invested in cash, but that's unlikely. So really that would suggest that less gearing is better. The more gearing you have, the further away you are from being able to retire in your 40s. Conversely, the second observation with respect to gearing is that if you retire in your 40s, and I just did an episode around, how much super do you need and talked about the longevity risk that is outliving your super. Well, you retire in your 40s, potentially you've got to fund the next 60 years of living expenses, which is a really long period of time. And that's what I spoke about in episode 314, that, so much super do you need episode. So if I need to fund 60 years, I need what I called in that that episode, a perpetual portfolio. I need enough capital growth because I don't want to run out of money. I've got 60 years to fund. I don't want to run out of money. So those two things are pulling in different directions, right? You don't want too much gearing because you're too far away from retirement, but you want more growth assets and more compounding capital growth, which suggests more gearing so that you don't eventually run out of money. Putting those 2 points together, you've got to find that right balance. What is that right balance? It's really going to depend on the time between now and retirement. So for you, about 20 years, and then how much income you might have over that 20-year period is probably going to dictate to what extent should you gear. The next consideration will be living expenses. Obviously, if you want to retire early 40s and you can live off an oily rag, $30,000 or $40,000 a year, you don't need a huge asset base in order to fund that, and that's going to be a realistic target. Whereas if you want to spend $150,000 a year and retire at mid-40s, obviously that's going to be a lot more challenging. You're going to need a huge pot of money in order to do that. Look, sometimes people's goals are, I just want to get out of the rat race. I want to not have to get out of bed and go to work. In the morning, I'm happy to make that compromise. That is, reduce my standard of living, live pretty basic. You've got to think carefully about that and whether that's going to suit you. It's going to suit a lot of people, and that's fine, but it's not going to suit everyone, of course. And so sometimes maybe a better solution would be to say, okay, I'm still going to work post 40, but I'm not going to work as hard as I am. That might mean that you might work part-time. You might work in blocks throughout the year, for 4 months and then take 4 months off. Or you might be doing a job that has less responsibility than what you're doing today. So it's sort of easier, it's less burdensome, I guess, from an emotional, physical and mental perspective. But thinking carefully about living expenses, because, you might be retired for a very long period of time. What are you going to do with your life over that time? If you're going to travel, that's going to give rise to higher costs. So thinking carefully about how that's going to work as well. Again, depending on your risk profile and income, I might consider, and particularly in your situation, you said you're in your 20s and you'd like to retire in your 40s. Actually, you said 26 years old and 40s if possible. So you've got a couple of decades up your sleeve. Maybe it's a case of being rather aggressive with gearing, and maybe your strategy involves selling down assets when you're ready for retirement. And you might choose those assets so that you're choosing the geographical location of that property, a market that's just about to enter into a growth cycle, or closer to entering into a growth cycle. So being particular around that, and then potentially buying assets that you can manufacture equity as well, so you can improve or develop the property. So what I'm suggesting there is maybe you go and buy an asset like that, or you could consider buying an asset like that, hold it for 15 years, develop it, then sell it. And that would reduce your debt and then potentially allow you then to transition into early retirement. So normally in a strategy, we wouldn't want to sell, or we wouldn't necessarily want to have to sell. We might. It might be our choice, but we wouldn't want to have a strategy that forced us to sell. But in your situation, maybe in fact that is not only necessary, but maybe it's desirable. So that's the other thing I'd be thinking about. And these all go in hand with my gearing comments, of course. And lastly, with respect to super, everyone can have $1.9 million in super and not pay any tax. That's called the transfer balance cap. That's the amount we can have in pension phase that's going to be tax-free, both from an investment earning perspective and a pension perspective. Now, you can access super at 60, but you don't necessarily need to have, if you're going to have 4 million of wealth, for example, theoretically, you'd want 1.9 of that inside super. Now, you don't necessarily have to get that in by the time you reach 60, even if you're still moving money in after your 60s, that's kind of okay, but it'd be silly to ignore it. You wouldn't want to put too much money into super if you wanted to retire in your mid-40s, because I would want to have it outside super so you've got full control over it. It's not locked away and you can actually achieve your goal. So I think probably around mid-40s I would start thinking about super, but you want to have a mind to how am I going to get this money into super and get at least 1.9 million of my overall wealth into super, say by mid sort of 60s. And you can probably do that, if you're thinking mid 40s, by the time you get to mid 60s, you've got 20 years to sort of move it in, or you can contribute $120,000 a year, and that's that's going to be indexed as a non-concessional contribution, so you can get the money into super relatively effectively. But in your situation, if you wanted early retirement, I probably wouldn't focus too much on super until you're in your mid-40s, which is kind of where you want to achieve your goal. So you mentioned in your question that you're not that focused on super, and I don't think that's necessarily a wrong approach. But good question, Kyle, and thank you very much for submitting it. And the next question is from Marty, and it's kind of on a similar theme. That's why I want to kind of answer them together. And by the way, for most readers or that have written in, they certainly give me some lovely feedback around the podcast and listening to the podcast and enjoying the content. Don't necessarily read that out in this forum, but I do want to acknowledge it. I do appreciate the lovely feedback that you're giving me, and it's great to receive that feedback. Anyway, Marty asks, I've got a question about retirement age. I can't remember if you've given much detail about this before, so feel free to point me to the right episode. He goes on to say, I'd like to know more about how you help clients figure out what's the appropriate age to retire. Is it just down to their financial returns and planned lifestyle they want? Or are there other factors like hobbies, family responsibilities, etc. that you coach them through? I've heard stories about people retiring in their 40s but return to work a few years later because they don't know what to do with themselves. It's a great question, Marty. I think people just want to have more flexibility. So whilst I might develop a strategy to say, look, here's how we're going to fund retirement so that you have the option to completely cease work at 60, the reality is that most clients work beyond that. And they might not work on a full-time basis, and they might not be doing what they're doing, in their normal career. They might seek to do other types of work. But that's the reality is, you're right. We get two things from paid employment typically: a sense of contributing to something beyond ourselves and an ability to sort of learn more and stretch. And so there was a study a while ago that there's about a 40% probability of depression in the first year of retirement. And this is a UK-based study. And the reason for that is because we don't have those two things. So if you're going to stop work fully, where are you going to continue to grow and learn? And what are you going to contribute to beyond your own self? And if you can answer those questions without paid employment, great. But if you want some sort of employment, that's probably what you're going to think about in terms of retirement. But from a retirement planning perspective, it doesn't really impact us too much. One, it's going to be really difficult to work out, if you're in your 40s today, what do you want to do in 20 years' time? That's pretty difficult to forecast. And secondly, what we want to do is sort of plan for the worst, hope for the best in a way. So plan to not necessarily have to get out of bed and go to work by the time I'm after 60 or in my 60s. But if I choose to do so, that's fine. In terms of, how do you work out the retirement age? It's really a function of three factors. How much do you need in retirement? So like how much are you going to spend? And typically what you spend today is a good proxy for that. In retirement, you're going to spend on different things. You might not have as much sort of daily travel if you're commuting into the office or something, but you'll go and play golf or do something like that. I find that if someone's spending $120,000 on general living expenses today, they're probably almost certainly going to spend $120,000 in retirement. So working out what you spend today is probably a good proxy for that, noting that maybe you'll spend more in the first 10 to 20 years of retirement. As you get older, typically there's less travel, maybe health might prevent you from doing as much activity as you might do in your 60s, for example. Then, of course, it's a function of how much wealth you have today, and then how long it will take you. What's the difference between how much wealth you need and how much you have today? That's going to kind of dictate when you are able to retire or when you afford to retire. A couple of sort of other comments I can share with respect to that question. 60 is typically a good target because that's when you can access your super if you're permanently retired, 65 if you're still working. And so aiming for 60 is good because it means that we can use a combination of super and other assets to fund retirement. I'd be really careful about assuming that a client's going to work far beyond, say, 65. I know that's kind of conservative, but, health sometimes is outside our control. And, I don't necessarily want to have a plan that assumes my client's going to be working 67, 70, sort of around that range. If I have to, I've got to, but I can't remember the last time I needed to do that. If you don't like the answer, maybe you need to make a compromise. So, if you work out, I need $120,000 to live, but, you've got very little assets to your name today and you're 55, well, maybe you're going to have to adjust that budget in terms of the $120,000. And if you want to retire before 60, well, then you kind of refer back to my previous answer to Kyle in terms of some of the considerations around that. So to return to your question, Marty, it's not really related to, their hobbies or those sorts of things. A lot of people don't know what they're going to do in retirement. It's really a little bit broader than that. And as we get closer to retirement, that's when we can, and certainly in retirement, that's when we can sort of tighten up those numbers. Okay, we're going to shift gears now and have a question from Jing, which is about investment structures. Jing writes, I'm reevaluating my long-term structure for holding property portfolio. Currently, I own a company that's under my family trust structure. The family trust has limited beneficiaries, including my minor daughter and my parents, one residing in Australia and the other overseas. My accountant has suggested setting up a bucket company owned by my family trust to handle all the property and share investments. Currently, withdrawals from the family trust incur around a 30% tax rate, which covers living expenses, interest payments on 3 properties, 2 investment properties in the home. The excess funds can be moved into the bucket company for investment. I'm seeking a second opinion on that strategy. Okay, Jing, I recorded an episode that you probably should listen to. It's called Would a Third Super Fund Help You Retire Early? And I recorded that. I published it on the 23rd of August 2023, so last year. And that's when I talk about using an investment company. For those who are listening, if you have a trust that has income, it has to distribute that income. As Jing said, that if he distributes any more to any of these individual beneficiaries, which include his parents or himself, he potentially triggers more tax. He doesn't need any more money personally because he's got enough to pay for living expenses. And so the accountant has quite correctly said, why don't we set up a corporate beneficiary? So it's a company that's a beneficiary of the family trust, and we'll just distribute the remaining profit into that company. The benefit is that the tax rate for companies are capped at 30%. So whether Jing distributes $100,000 or $100 million into that company, he's only ever going to pay 30% tax. Whereas again, if he distributed more out to individual beneficiaries, he's going to pay more. One word of warning, Jing, you want to have the shares in that company owned by the family trust. So therefore, if it pays a dividend down the track, it goes back into the family trust and you've got then discretion of where that dividend goes, whether it's to you or your parents, or maybe your daughter is an adult at that stage, for example. But sometimes we've seen them set up incorrectly and the shares are owned by the family trust. The only downside to investing through a company is the companies don't get a capital gains tax discount. So whereas you do an individual or trust name, which means that we all know that the highest marginal tax rate is 47%, but if we get a 50% capital gains tax discount, essentially means we'll be paying capital gains tax at half that rate, so 23.5%. Whereas, as I said, a company has a flat tax rate of 30%. So on capital gains, you're going to be paying 6.5% more in capital gains tax. So 6.5% of the net gain in additional tax if you invest in a company. But of course, the benefits are, as I said, your tax rate between now and then when that capital gain eventually crystallizes is capped at 30%. You get a credit for all the tax that you pay in a company called invitation credits. I've spoken about them previously in this podcast, which means that when you're retired, you can pay out dividends to yourself or other individuals and get a credit for that tax that you've already paid. And you can retain profits in a company. Unlike a trust, you don't need to pay them out each and individual year. You can retain earnings in a company. I don't really like putting property in a corporate beneficiary, not totally against it. I've done it on occasions, but as a general rule, I would prefer to typically have property in personal names and then the corporate beneficiary can be invested in the share market. And the reason for that is negative gearing. If you're going to borrow to invest, better do that in your personal name. We can distribute more money via the trust into you to soak up that negative gearing. And again, you'll be able to benefit from the capital gains tax discount in the future. If you end up having a personal portfolio that starts to become positive cash flow, well, you can always gear against the equity to reduce the taxable income from that portfolio. So it gives you that flexibility. And the more you put into the bucket company, and particularly if you invest in the share market, the way I look at that is to say, well, you're going to have a large pool of assets there. They're going to deliver you an income that then can satisfy or pay for any mortgages in your personal name that you've used to, buy investment properties. So it kind of replaces earned income that can generate an income stream. So the short answer is, from what you've told me, I like the idea. Just a couple couple of things to think about there. Next question here is from Steve. It's a really interesting one, a really good point I can make from it too. He said, I just listened to your most recent episode on cost of living expenses and how that might affect the retirement balance required. I was wondering what the benefit is of working, for example, a year longer rather than drawing on your super. I remember being told ages ago it was like 2.5 years worth of extra retirement income. Is that correct? It's a really great question, Steve. Actually, I think we can greatly underestimate the long-term compounding impact of working a little bit longer and therefore delaying eating into our retirement savings. In fact, I did a quick calc just to demonstrate this, but it also depends on how much you're spending, how much you're earning, what your super balance is. So I don't know if there's a perfect rule of thumb that it's an extra 2.5 years because it's going to depend greatly on those factors. But for example, someone earning $250,000 a year, spending $120,000 a year with $850,000 of super at age 60. So 250 income, they spend 120 on living expenses and have 850 in super. If they work another 5 years, that is retire at age 65, I worked out their super will last them 20 years. Whereas if they don't work to age 65 and they retire at 60, their super lasts almost 8 years. So the extra 5 years of working has more than doubled the time that their super will last. It's a huge impact, right? And there's two reasons for that. Firstly, the longer you work, it avoids drawing in and start spending your capital and allows those assets to compound even further. And then secondly, the longer you work, the more arguably you can contribute. So that example that I just gave you, working extra 5 years, of course, it assumes we're contributing all our surplus cash flow into super, into investments. So it does have a big impact. And as I said, have a look at episode 314, where I talk about sort of how much super you need, where I sort of talked about some of the considerations there. And the final question is from SR. It's a bit of a 2 or 3 part question, really. SR writes, and obviously that's his initials. He writes, about 2 years ago, when I first heard you on another podcast, I was really impressed with what you had to say, and I contacted your office to see if I could use your holistic services. Unfortunately, I was rejected and wasn't totally sure of the reason why. Nevertheless, I have followed your podcast ever since. I just want to jump in here because it's not really a question, it's observation. In fact, I'm planning to do some sort of webinar, maybe a live YouTube event, something like that, to talk about this fact because it's a really important thing. There's a few points I really want to touch on very briefly here. Firstly, I just read some research over the weekend. The minimum fee that advisors are charging is $4,000 a year. You know, that the minimum fee has to be high just because it is so costly to run advice business. It's entirely thanks to the government. They've completely messed up the industry. Both sides of government, by the way, have made an equally poor contribution to this. But the reality is that minimum fees are high. I need to talk about why that is. I also want to talk about, what things should you consider when you're paying for advice? Things like the scope, the value, whether there's independence associated with it. There's a few people out there sort of selling advice, but really it's not really advice per se. So we want to start thinking about that. And then also I want to talk about, what I consider when taking on new client, because I really put myself in your shoes. And the reality is that if someone's going to pay me, let's say $5,000 a year for the next 10 years, that's $50,000. I need to be absolutely sure that I can deliver multiples of that in terms of value. So that is, would that client be substantially better off paying me $50,000 over the next 10 years? And really the question that I and anyone in my business asks is, if this client was my brother or sister, what would I be telling them? Would I say, don't bother, it's not worth you paying that amount because there's just not enough scope for us to add value? And so that's probably SR the main reason there. But anyway, it's a really important topic that I need to address at some point in the future. Okay, so SR now is a 2-part question. He goes, you're a big advocate for using holistic advice, and I am. It makes a lot of sense. As hard as I try, I have found it very difficult to find an advisor/firm that provides the financial package of services you recommend. As I was unsuccessful with using your service, can you recommend any other advisors/firms or the best way to find a holistic firm? It's a great question, SR. In fact, I would say it's easy to say you're a holistic business, but really difficult to execute. We put a lot of effort into it. Requires really good systems training and a willingness to invest. I mean, just very quickly, some of the things that we've been working on in our business is, a great cost. We've implemented just recently a technology system that allows us to store and share information information all in one place across the whole firm. So all files, emails, phone calls, conversations. That way we all can know what's going on with the client. We've invested a lot of time and money in order to do that. We meet regularly as a whole team to discuss existing and new clients. That there's not a lot of economies in scale, pulling everyone away from their desks and sitting them around a table and talking about clients one-on-one, one client at a time. But it really gives rise to the greatest opportunities to find value and train our team. And the other thing we've been really focused on is telling stories. Again, it's a means of sort of sharing knowledge across the whole business. So we're trying to, pull those good stories out and tell each other about what we've been doing for our clients. It's a really challenging thing to do as a business, but really easy to put on the website. We're holistic. But in terms of implementing that, how do you find a good firm in order to do that? It's really challenging. Also, you want to find an advice business that knows just as much about property as they do shares and super. That's really challenging as well. I think the only thing I can answer is seek a referral from someone that you know or trust that's found someone like that. Referrals often the best way to go, but I think I'm optimistic that there's going to be more businesses like ours that will pop up over time. Now, the second part to SR's question is I'm in the process of deciding on a new investment plan as I've turned 50. Congratulations. I'm almost own my own home valued at $2 million. I've got an investment property worth $1 million and $500,000 in super and have approximately $1.2 million of borrowing capacity. I also have a monthly surplus income of $6,000. I'm thinking of using this equity to purchase another investment property, but was interested in where you would spend the $1.2 million from the bank if you had 10 years until retirement. This is a really good question. Of course, it's not advice because I don't necessarily know everything about your situation, but maybe my approach to answering this question would also help others. So firstly, let's talk about the investment property. Let's assume the investment property is a good quality asset. If it is, and it should perform kind of median, then in 10 years, and this is not going to happen necessarily on a straight line basis, but in 10 years, your $1 million asset should be worth 2, and in 20 years, it should be 4. That's 7.2% compounding growth over the next 20 years. You're going to have $3 million of equity. So arguably, you don't need more property. So you're going to have $4 million invested in a property, and who knows what your super balance is going to be in 20 years. It's kind of a little bit skewy because super obviously is far more tax effective. Today, you can have 1.9 in pension phase, which is the tax-free amount. So I would argue you don't need more property. You need to put more money in super. So I worked out if you work for another 10 years, and let's say you contribute around $20,000 a year from employer concessional contributions. I had to make that assumption. I don't know what your income is or what you're contributing, but I had to make an assumption. So 20 grand a year for the next 10 years. I worked out your balance will grow to about $1.2 million. So pretty considerable over the next 10 years. That's because it takes such a long time to get to $500,000, but obviously as that's demonstrated, a lot shorter time to get to $1 million. Anyway, $1.2 million is about 940 grand in today's dollars in 10 years time. So pretty healthy super balance, but still not maximizing the full tax-free portion that super could provide. Whereas if you contributed your $6,000 a month into super for the next 10 years, and you would do it monthly, by the way, and whether that's concessional it'll be a combination, I should say, of potentially concessional contributions and then non-concessional contributions. Anyway, I worked out your balance in 10 years' time would be an extra $1 million. So instead of 1.2, it would be 2.2 million, which is about $1.7 million in today's dollars. And remember in episode 314, I talked about, how much super do you need to have a perpetual portfolio? It was 1.75, but 1.7 will get you there. So in actual fact, if you don't go and borrow to invest and then put all that money inside super, that's going to probably do all the work that you need it to do. Whereas if you go and buy an investment property, it's probably going to absorb most of that $6,000 a month, therefore not permitting you to make additional super contributions. And in 10 years' time, the cash flow that the property is going to generate is probably still going to be negative, like it's going to be taking money out of your pocket, and you'll be sensitive to interest rate changes, tenant changes in tenancy laws, maintenance costs coming up, all those sorts of things. So you might then have to go and sell the investment property, but you've only held it for 10 years, so net of selling costs and capital gains tax, that's not really an efficient way to approach it. But of course, make sure your super is well invested. So that is, you want a fund that's going to give you good returns and low fees, which in fact is a great segue into tomorrow's podcast because that's exactly what I'm going to talk about. Anyway, SR, thanks so much for the question. It's been a good one. Thanks everyone for submitting their questions. As I said, I'm going to try and get through them, and hopefully you enjoy enjoy these Q&A episodes, and if you do, I will record more of them. Thanks, guys, and until tomorrow, bye for now.